Hi everybody and welcome to another daily presentation. This is the market overview for the 19th of August of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. Now the first and sole topic of the day is going to be about gold, which has soared once again into fresh historic record highs after Friday's session. So the precious metal has indeed soared into new historic highs on Friday's session, buoyed by dovish Fed calls, but also brewing geopolitical uncertainty, which is stemming across the globe. Now, gold is now floating around at about the $2,500 per ounce area in the European session, and it has decent bullish momentum on its side, we must say, indicating that probably we're going to see it rising even further from here. Now, the shiny metal has capitalized on the fall of bond yields and the greenback late last week and received renewed safe haven interest from investors as money market participants hold dearly to their beliefs that the Federal Reserve will not have a choice but to slash its key policy rate at the September meeting, since we have seen the latest labor market update, foretelling that the prolongment of the central banks or the current monetary policy regime of the central bank will inevitably bring undue harm on the US economy. Therefore, money market participants foresee that Federal Reserve will slash rates in September, November, and December, and in a sense mark at the September meeting its pivot towards looser financial conditions in order to avoid the United States economy falling into a recession. And prolonging the current monetary policy regime is going to bring forward, in a sense, these lagging effects of its policy actions, which again is going to not synchronize the timing of the trajectory of the policy decisions going forward, which again can bring undue harm on the US economy. Now, currently 100 basis points of easing of rate reductions is expected, is in pipeline from economists, at least from economists' point of views and money market participants' point of views, which is split in a sense with a 50 basis point cut at the September meeting, so quote unquote a jumbo decisive cut in September, followed by two 25 basis point cuts at the remaining two meetings of the year, so November and December. Total cumulative cuts, 100 basis points, are currently being priced in. This is going to leave a key policy rate of 4.5% by year's end. So, yep. We will see whether that is the case. Now, monetary policy outlooks, however, are not the only driver that propel the shiny metal north, as at the end of the day, we see geopolitical uncertainty and tensions in the Middle East, but also in Eastern Europe, more specifically, keeping traders on high alert and high watch, standing ready to flock towards or flee towards the safe haven destination, gold, in a scenario where tensions transcend worries and actualize, if you would like. So we must start by saying that the recent reports have outlined that the U.S. Secretary of State, Anthony Blinken, is heading back towards Israel to, again, attempt to broker ceasefire negotiations and a deal between Hamas and Israel in regards to the Gaza war that has been going on for 10 months now. So October is 2 months away. So yeah, 10 months now. However, we must say that the ongoing strikes from Israel in the north and the exchanges that it has with Hezbollah of Lebanon, alongside the conflicting statements from Hamas officials and Israeli officials in regards to what the ceasefire plans should be and what conditions shall be met and whatnot, has indeed dampened and still dampens the chances for a breakthrough or a breakthrough for peace. And not only that, Tehran's retaliatory expectations, they have not been taken place yet, but they are still looming in the horizon. At least the threats are there. So Tehran's retaliatory expectation and the aggressive posturing up by Iran and Israel as well. After the assassination of Haniyeh in Tehran late last month on Iranian soil, is putting a backstop on this kind of negotiations, is aggravating the situation more. It's complicating further the situation, and it does threaten to put a dangerous spin on the state of affairs in Middle East, in the region, the wider region in general, and and amplify the chances for an all-out war, which, to be fair, we see that stemming from the Israeli side for sure. They are indeed looking aggressive, and their actions and their commentary is indeed pointing to an escalation of war into the wide area. Iran is not backing up anyways as well, so they see themselves going at war. Hopefully we will not come down to that. Hopefully some sort of logical and mediation with sanity is going to take place and avoid this situation from coming into fruition. But yeah, that ultimately depends upon the temperament of these two nations and the ones that are currently intervening or brokering, acting as brokers between these two nations, or not escalating situation. It's going to be ultimately dependent upon that, obviously. We will see how the whole thing is going to unfold in the next few days and weeks. So additionally, we must also point out that concerns about an escalation between Ukraine and Russia are also on close watch, as we have seen late last week. Ukrainian forces advancing paradoxically into the Kursk region in Russia, so breaking through into Russian territory. For whatever reason, they have chosen to go on an offensive and not push back on the current front in the southern region, where it's currently occupied by Russian forces. They chose to go into Russian territory, and they have renewed commitment from European and Western allies, more specifically backing their actions. So yeah, this threatens also the prolongment of the war between Russia and Ukraine from being extended into the future, and possibly with much more aggravated kind of tensions, because as we just mentioned, we have seen months-long stalemate between these two nations, and there were hopes that we're going to reach a sort of agreement to end the war. This kind of move by Ukraine does not seem to say much for ending the conflict, but yeah, we will see what the reaction from the Russian forces will be in the next few days and weeks as well. But for the time being, this kind of move is definitely pushing geopolitical analysts back on their toes and start to project what's going to happen further from here, updating, in a sense, their forecast for graver and escalatory kind of exchanges between the two. Hopefully it's not going to drag into the war other nations which are indirectly participating in this war, we have to say. But yeah, again, the situation is geopolitical uncertainty, and this dovish kind of Fed outlook going forward from money market participants is indeed channeling flows into safe haven commodity. We're talking about gold here. We expect it to keep controlling in this kind of favorable treatment. Again, up next for investors this week and for the trajectory of the precious is going to be the speech from Fed Chair Powell, but also the latest FOMC meeting minutes, which is going to give us more clues as how the central bank is going to behave with the monetary policy decisions going forward. We will be looking closely at that, and we will be giving you guys updates on the implications and possibly some sort of calls on what to expect to happen in the immediate or the near future. For the time being, we're gonna keep this update as short as we can, so we're gonna leave it here. Thanks for watching, guys, and we will catch you onto tomorrow's session for another update. For the time being, take care. Bye bye. Welcome everybody to another episode of our series, our webinar series. Today we're going to talk about moving average convergence and divergence strategies, or in other words, we're going to talk about what is the MACD and how you can apply that to your trading regime or to your trading plan, if you would like. So we have discussed this topic in the past. Today is going to be a much like refresher. Okay, so we're going to bring up to speed in a sense what we have learned in the past. We're going to refresh our memories, and after we get past these slides, this presentation, we're going to go on a live environment and apply what we just discussed. Okay, so the first half is going to be more like an educational, going through the lectures kind of vibe, and then we're going to move on to the live environment. So at the time we're going to do that, please let me know whether you can, whether you want to look at one specific instrument, or if you have preference, that's what I mean. If not, I'll just bring up some random charts and we're going to discuss how you can, in a sense, put into action what we just covered. So again, today's webinar is going to be moving average convergence and divergence, and in a sense, strategies. Let's get started. This is a quick warning, risk warning, and a disclaimer. You can read this at your own time. So moving on. So there are, in the past, I've mentioned I'd like to split this kind of topic meaning whatever comes under technical analysis, into two main branches. One of them is charting analysis. The other one is what you have in front of you, the mechanical analysis. And from here onwards, I've decided to split it into further two groups, which are on chart and off chart indicators, technical indicators, the stuff that technical analysts or technical traders use in order to, in a sense, amass the highest percent of probabilities of chances of succeeding at placing their trades and placing their trades accordingly. Okay, so mechanical analysis is being split off
into two branches, on chart and off chart. We have covered in the past moving averages, Bollinger Bands, in the Fibonacci retracement. These have been extensive topics that we went over, and all these three types I've just mentioned, these technical indicators, have been covered in the past, and they fall under the category of on-chart indicators. Technical indicators, you're going to find them in a sense on top of price action, whereas on the other side of the equation, the other kind of split of the other branch of mechanical analysis is what we call off-chart indicators, which are in a sense can be in a sense found on a separate window below the price action. It's not going to be overlaid on top of price action. It's going to be below that on a different segment. Most of these are oscillators, and we have covered so far the relative strength index, the RSI. We have covered momentum. Today we're going to cover moving average convergence and divergence, which is the main topic of the day. And again, discuss possible strategies that you can undertake while using this technical indicator. So, what is MACD? What is moving average convergence and divergence? Okay. This is a technical definition, again, to refresh our memory. So the moving average convergence divergence is a trend following momentum indicator that measures the relationship of two moving averages, hence the name moving average convergence and divergence. So it applies, it uses to moving average, much like we have done in the prior webinar. We have discussed moving average strategies, not MACD strategies, but moving average strategies. MACD adds another dimension, which is the momentum. Two moving averages, in a sense, the reason why you use them is in a sense to gauge the direction of the trend and whether you have spotted whether the trend is starting to reverse, or at the opposite side, or the flip side of the coin, whether it is going to continue or has been continuing to moving to that desired direction. The MACD, the oscillator, in a sense, adds on the extra parameter, which is momentum. Hence, it creates the extra two words in the title. So moving average, the convergence and divergence aspect of it comes in because we turn it into an oscillator, and hence the MACD name. So it is used to spot changes. We're talking about MACD here, obviously. Used to spot changes in the strength, direction, and momentum, but also duration of a trend in an instrument's price. So moving average by themselves give you plain direction. Okay, MACD gives you how strong the trend is. Obviously, it gives you the direction of the trend. How fast are the prices evolving or climbing or falling, which is, in other words, of describing momentum, but also how long these kind of fluctuations between up and down, or north or south, or whatever that is, have been taken place. So for how long? So it also describes duration of a trend. Excuse me. It outlays that duration. Okay, and all these are important factors that we do need to take into consideration when we apply the MACD on our charts. It's not merely about identifying the current trend. It also gives us the other valuable aspects, which are the strength, momentum, but also the duration. Okay, so once added to the chart, it can be found on the bottom of the price action. Since it is an oscillator, much like RSI, much like R Williams, much like stochastic, these are all oscillators, which again, at the end of the day, measures the strength of the prevailing trend alongside with possible signals of the change in a trend. Okay, so what we do care about when we use MACD is whether the trend has shifted, or whether the indicator is validating that the trend is going to continue, or has been, or it is currently continuing on towards the primary direction. So It can also be plotted as a histogram. Okay, it's another aspect of the MACD indicator, which moves above and below the baseline, the zero line, what we call, and signals either strength or weakness in price. You can visualize this much like the RSI. So above 50 gives you an indication that price action is moving to higher ground. The bulls are in control, whereas below 50 reading of RSI means that the bears are in control. Much like the same fashion is the MACD indicator. So above the baseline, above the zero level, that means a prevailing strength of the move is in favor of the bulls, whereas below the zero line, below the baseline, the bears are taking, in a sense, control, are driving the price action. Okay, so the MACD is used by pretty much all types of traders. It does not discriminate against people that like to place orders or open positions or close positions on either a short time frame, medium or long term. So it has the usages on any given time frame. So scalpers can use it, are actually using it. Position traders are using it. Swing traders more primarily are using it, and many other types of traders are actually using this. Okay, because it has significantly substantial kind of valid signals. Obviously, if you learn how to decipher the information that it portrays. Okay, so it is indeed a useful technical indicator. I personally like it a lot. And something else to keep an eye out when we're talking about moving averages in general, hence moving average convergence and divergence as an indicator, is a lagging indicator, it's a trend following indicator. So therefore, if you have a trend, yes, it's useful. Either the market moves upwards or downwards, yes, it is useful. Whereas if you have an instrument that is trading on a sideways fashion or in trading range, it's not going anywhere, it's just going up and down within a tight bound for a prolonged period of time, in a sense, having no identifiable direction, MACD is not that useful. And in those kind of occasions, is recommended not to be used. You can use, for example, stochastic. It's much more accurate on a trendless kind of market compared to MACD, which is primarily targeted and used for trending markets. Okay, something you need to have at the back of your mind. Okay, so cover this. Let's move on to the next slide. So this is a visual illustration of what the Mark D looks like. It's going to be, you can see that clearly below the price action. So it has a separate panel or a separate box or rectangle, whatever you want to call that, that goes beneath the price action. Is not on the top of price action. Okay, again, mainly because it's an oscillator. It needs its own parameters and its own scale. So, and the snapshot below visually illustrates one of the key functions of the MACD that we do need to learn and understand and take note of once they arise. And more specifically, it talks about divergence. Obviously, hence it's the name, moving average, convergence, and divergence. These are the stuff we'll look at in order to get, in a sense, a heads up that the trend is, in a sense, to spot as soon as possible where the trend has shifted. Okay, it's not going to tell you when the trend is going to shift, or that the trend is about to shift in I don't know, 10 periods, but is compiling information about the past. It's a lagging indicator, so in a sense it shows you things that already have happened. Okay, but using the divergence element, okay, spotting these kind of divergences. For example, price action makes higher highs and higher lows, whereas the MACD indicator below the chart is not validating that. For example, it makes lower highs and lower lows. Okay, so they move in different directions. This is what we call a divergence, and more specifically in this kind of cases, a negative divergence. And it's an early sign that, you know what, the trend is going to shift or has shifted, and from there onwards we can adjust accordingly and we can play this accordingly. The point is to learn how to spot this, and once you spot them, to know, in a sense, have a playbook on how to approach this kind of situation. Okay, because it happens relatively frequently. Okay, divergences can't be spotted on any given instrument. The point is you need to pay attention to that specifically, but also, there's some instruments that do this once every while. There's some instruments that pretty much do this on a regular basis. Obviously, it's up to the price action, and it lays on the specificity of the instrument. Okay, so the moving average convergence divergence takes, in a sense, two trend following indicators, and you use two periods, a short period and a long period. Most people, or the default settings of the MACD are 12 periods and 26, 12 for the short and 26 for the long. Exponential moving averages. Okay, you can do simple moving average as well. Doesn't matter. It does matter, but these settings and the usage of the MACD can be defined or predetermined by using a simple moving average rather than an exponential. Personal liking, I do exponential. You can do simple, the same thing. The point is to understand what information is it conveying to you. Okay. So it takes two trend following indicators, 12 periods and 26 periods, and turns them into a momentum oscillator by subtracting, the shorter EMA from the longer one. Okay, much like the moving average strategies we have done in the past. So we were looking for the crossovers of the 12, the short-term moving average, above the long, the 26-period moving average in this kind of case, for us to gauge that the market has indeed shifted its trend. So therefore, when you see a crossover between the small and the long, and you see the small moving average crossing above the long moving average, this creates what we call the bullish cross, or the bullish signal, in other words, or the golden cross, which is obviously an early indication for going long. Whereas when you see the short moving average crossing below the long-term moving average, you get what we call a death cross, or a signal, or a bearish cross, which is a signal to go short. Okay, pretty much simple stuff so far. Okay, so the MACD, when the MACD crosses above zero, what we call the baseline, it signals positive momentum, and this is what I just mentioned before. And when it falls below the zero line, it indicates negative momentum. So all these, again, are relative, and we need to pay attention to this. So where the moving average convergence divergence line is and the signal line is either above or below the zero line has different implications. And we also have what we call the trigger line, or the signal line, which is a 9-period exponential moving average of the MACD, which is what we subtract from the sum of the difference between the 26 and the 12, which gives us, in a sense, the MACD line. Okay, is what we do care about. So the crossovers between the trigger line are used in a similar fashion as crossovers between two moving average, what we just discussed. Okay, so MACD is, in a sense, the MACD line, which is the difference between the 12 and the 26. Okay, most of the times you're going to see that as a blue line. This is what we're going to refer to it as. Okay, so when you see the MACD line crossing above the signal line, which is the red line, you're going to see visually represented, creates the same thing, the bullish crossover. Whereas when you see the MACD line, again, the blue line, crossing below the signal line, the red line, this creates what we call the bearish cross. Okay, and that's the short signal. Okay, you will see that in action pretty soon. So fear not, if you have any sort of questions, please send them through. But so far, I think everything is relatively simple. Okay, so the indicator shows a blue line, the MACD, and the red line, which is called the signal line, but also the histogram, which is the difference between the two. And in a sense, the histogram calculates the difference between the two lines. So the values are calculated from the price of the trading instrument in the main part of the graph. And for example, okay, so for visual illustration purposes only, let's discuss this upcoming scenarios. Okay, so in a sense, this you see the MACD line, the blue line, which is the difference between the 12 and the 26 period, which we just said. The signal line is the 9-period exponential moving average. Okay, And you also have the histogram, which is the difference between the blue and the red line. So the period of the moving average on which the MACD is based can vary, okay? And you can use, instead of 12 and 26, you can do 20 and 50, okay? You do you, okay? But the most common parameters involve a faster EMA, which is the 12 period, and the 26, and the signal line is most of the times the 9. So when you hear someone, ask someone, for example, what are your MACD settings? Okay, he's going to say, for example, 12, 26, and 9. Okay, so 12 refers to the short-term moving average, 26 refers to the long-term moving average, okay, and the 9 is the signal line. Okay, so this is one way to conceptualize this. Okay, so MACD visualization, once again, okay, what do we care about is first and foremost, it's actually not with a hierarchical order. I'm just going to outlay the stuff that we do need to pay attention to, at least when you use the MACD indicator. That's the whole point. So you look for the crossovers between the blue line and the red line. So the MACD line with a signal line. These are stuff that we do look for. Okay, another time happen here as well, here as well. Okay, a time here, another one here. Okay, and the first thing, this is something else. This is the primary thing that we pay attention to, but also we pay attention to the relative positioning of the MACD line, more specifically the blue line, whether is up above the upper quadrant, or if you like the baseline. This is the baseline. Yep, my handwriting is not going to get better anytime soon, so please bear with me. So the baseline is what we call also the zero line. So we do care about crossovers, but we do also care about where the blue line is, okay, either above, which signals positive momentum, or below, which is negative momentum, okay? And in this kind of case, we see, for example, here that, yes, the momentum is with the bears because it's below the MACD line, the blue line. This one is below the zero line. That means the bears are in control, but their strength is weakening because you see the momentum waning out. Okay. And on the contrary, when you get the crossover, okay, you see a histogram recording a value of 0, obviously, because it's the difference between the MACD line and the signal line. This is what you would have expected, okay? So in contrast, when you see the blue line, the MACD line, this at this point here, crossing into positive territory, okay, from negative to positive, that means in a sense that the bearish momentum is waning out, and the momentum now starts to lay on the side of the bulls. So the bulls have taken control of the price action in this kind of scenario. And there, from here onwards, you can see the momentum waning out from the bulls, the bears taking control, flattening out here, okay? And you see the bears taking the initiative once again. So the momentum is on the side of the bears. In this kind of case, we see this kind of flatlining here. So nobody's in control in this kind of region, if you would like. But as soon as you see the MACD line, the blue line crossing below, okay, the price action, excuse me, not the price action, below the zero line, this creates the sell signal in a sense that gives you a heads up that the bears are in control and the momentum is strengthening. And in this case, it kind of faked out, but it continued moving stronger. Okay. So this translates into sharper falls of the price action. Okay. You can clearly see here coinciding with this. Okay. Clearly. Also, something else to note is that whenever you get crossovers, okay, this is the early signal. This is the early signal, once again, in this kind of cases, to sell. This is an early signal to buy. But the ultimate signal comes, okay, when you get the confirmation that the bullish momentum, yes, the crossover, the bullish crossover has occurred. First warning sign, you flag this crossover, but your signal to enter is when you get a definitive signal that the bulls are in control of the momentum and the move. So the definitive signal takes place when you see the MACD line, the blue line crossing above the zero line. And this, if you can extend this upwards towards the price action, is going to coincide, okay, with this crossover, which is as two moving averages, okay, a 12 and a 26. Signals that the trend has indeed shifted. But see, it's too late. We've left behind all this kind of move. So an early signal, some traders like to enter, okay, as soon as the crossover occurs and as soon as you have the fade out of the bears, okay, this is the extra validation, the fade out of the bears and the acceleration of the price action because the bulls have entered the picture. This is what they're trying to capitalize. In a sense, they try to front run, okay? You can clearly see that the signal to enter is much sooner, okay? And in this kind of case, much more handy and convenient compared to the actual signal that was created when you saw the crossover of the MACD line above the threshold, above the zero line, above the baseline, okay? So opposite case, for example, can be found somewhere in here. You see the momentum of the bulls waning out, narrowing out, and then you see indecision. So this is a pivot point. This is where you see a shift in the trend, okay? And as you see the crossover, which is in a sense a signal to go short, coming up in here using the crossover between the MACD line and the blue line, okay? Which is somewhere in here, early signal to go short, okay? And the actual signal came here, okay? Obviously. In this kind of case, it worked nicely. You didn't let a lot of money on the table, but still, entering the market as soon as you see the crossover is much more riskier compared to seeing the crossover, but also waiting for the MACD line to cross the threshold, the zero line, the baseline. Okay, this is the ultimate signal to enter, not this. Okay. But some traders like to jump the gun in order to leave as less money on the table as possible. So maybe this can be deciphered as a signal, and this is the actual enforceable action. So you get the sign here, the signal, and you actually enter the position here. Now, the question arises, when do you exit this trade, okay, while using the moving average convergence divergence? Some people like to use the first initial crossover on the opposite direction. Obviously, this, you see the MACD line crossing below the signal line, bearish signal. So you await for the MACD line to cross above the signal line for your exit, which is, in this kind of case, you see, obviously, the baseline recording a value of 0. Excuse me, the histogram recording a value of 0, which somewhat coincides with this area right here. So this is your covering of your position, okay? So cover, if you went short there, you cover your position here, and you have this much profit, okay? Because you went short, price action fell, you are in a profit, okay? But note that this has been this kind of situation, in this example, where is the mouse? Here, okay? In this kind of situation, this was an early signal, okay, that the trend was about to shift. Just give me a few moments, guys. I need to, yeah. An early signal to exit the position, and you left a lot of money on the table. Look at this. You left all of this behind because you jumped the gun while using only the crossovers, okay? Some people, once again, like to exit the position once you see this again, which in this kind of case, once again, it kind of coincides with the same level. Again, you leave a lot of money on the table. So the best thing you could have done is a way for, in a sense, to see what's going to happen with this. Okay. And is the momentum of the bulls, okay, strong enough to overcome this kind of built up pressure by the sellers or not. In this kind of case, the fact that you see the histogram bars not being large enough, okay, this would have been a definitive exit signal for me. But this did not happen, okay? You see small difference between the two, okay? And we're not even discussing divergence, by the way, here, yep? This was your extra validation. So you are wait for the whole thing to unfold once again. You want to see what is going to happen after the crossover before exiting. In this kind of case, if you have risked it, much more money in the bank. Signal for you to exit would have been somewhere in here, which is, let's just assume somewhere in here. Okay. So you have a lot more money left in a sense in the chamber, but you don't take it. You leave it on the table and you walk away. Okay. Which is not always bad. Let's just say not getting greedy is one of the virtues of trading. If you do have that virtue, some people get greedy and you leave a lot of money on the table, the fearing that you're going to leave a lot of money on the table. And for example, you just stay stubborn and you leave the position open and this happens and you don't pay attention to it. And then the price action comes up here and you barely equalize. Okay. You manage to, in a sense, get out of the position, losing, not losing money, but leaving a lot more on the table. Okay, so taking wins, it's a good thing. Okay, closing the positions early, not too early, but early. Okay, as soon as you see a definitive signal, it's okay, rather than just stubbornly sticking to your position, leaving it open, and in a sense wiping whatever profit you have made and possibly giving out some sort of losses. Okay, for the time being, take the single. You have perfectly timed the market. You do indeed take a lovely position here. You see the first definitive signal, take it out. No, at the end of the day, it's a win. A win is a win, no matter what. Okay, so same logic can be applied to when you close your trades as well. So if you open a position and the market reverses, it goes the opposite direction in a sense, and you are losing money, it's essential to learn how to close that position with as minimal losses as possible. Okay, and taking the loss and moving forward rather than leaving the position open, hoping that someday or sometime in the future you're gonna break even or possibly make money. Okay, at the end of the day, you keep your funds locked in a position that you should have closed a long time ago, and move somewhere else. And now you're stuck looking at the same thing and biting your nails and becoming nervous that, oh, when it's gonna pivot away and raise to that level that I'm gonna break even or possibly make money. There's no need to do that. Just take the loss and move forward. Okay, losses are indeed part of the game. The sooner you get familiar with them, not get complacent about it, but still accept the fact that you're going to have losses, but don't look out to make losses. In a sense, making sure that you are diligent enough to close your position once you make a mistake or an error judgment is, again, something that is a virtue in trading circles, if you will, like. Okay, so enough will be about blabbering about stuff. Let's move on to the next slide. So now we're going to talk about the exponential moving averages, which in a sense highlight recent changes in the trading instrument's price, and by comparing EMAs of different lengths, hence the 12 and the 26, the MACD line gauges changes in the trend of an instrument. This is why we use them, why we use the two time periods. Okay, so we need to use a long term and a short term in order to see whether the short term trend is shifting and is gonna challenge the long term kind of trend. Okay, and again, 12 and 26 periods from a zoomed out perspective are not a lot. I've seen people use moving averages of 50 periods and 200. So there's no comparison between 12 and 26. So it's a whole different ball game there. So when we're gonna talk about primary trends and intermediate trends and short-term trends and all that kind of stuff, for the time being, we are focusing on the 12 and the 26, which, excuse me, which are ideal for quote unquote short-term kind of short to medium kind of trends. Okay. So, where did we? Where were we? Okay. So by comparing EMAs of different lengths, multi-line gauges the changes in the trend of the instrument. Yep. And by comparing differences in the change of that line to an average, the analyst can identify subtle shifts in the strength and direction of any instrument. Excuse me, guys. Analysts can identify subtle shifts in the strength and direction of an instrument's trend. So traders recognize 3 meaningful signals generated by the MACD indicator, which is when the MACD line crosses the signal line. Give me 1 sec. Which is what we have discussed in the past. We're talking about this. This is the first type of signal. Okay. When the MACD line crosses the 0 line, which is this signal, and when there is divergence between the MACD line and between the histogram. Okay. We're going to discuss that on a live environment. Okay. So graphically, this corresponds to the red line crossing the histogram, the blue line crossing the x-axis, and the price action is making higher highs. Okay. Whereas the histogram, okay, creates lower highs. Okay. Something different in a sense than what the price action. Let's see if we can spot that here. So we see the price action, okay, making higher highs. Okay. Higher highs without a doubt. Whereas the histogram does not. This is divergence. Okay. This does not coincide. The histogram bars, where is it? The histogram bars are not coinciding with the price action in this kind of region right here. Okay. You see upwards, moving downwards. Okay. This signals that the momentum is waning, and therefore you prepare for a shift in trend. Okay. And the shift comes right here with this kind of signal. This is why it was appropriate to enter at this kind of level, because you saw the divergence beforehand. Okay. Do we see any other sort of divergences here? I don't think so. Okay. You see MACD here recording a high. From here onwards, you see them moving to lower ground. Price action does move on to lower ground, coincides. Then you see a formation of a low, okay, and then a shift upwards, pretty much self-explanatory. But from here onwards, 1, 2, 3 highs. Let's just say 1, 2. Where is the third? Nowhere. Okay, the histogram bar should have been somewhere up here. Not the case. And this is what we call divergence. Okay. Price action is making higher highs, whereas the MACD, the histogram bar below the chart on the oscillator, the MACD is recording lower highs. Okay. One is moving upwards, the other one is moving downwards. Signals an early signal that the shift may be pivoting away. Okay. So again, pretty much described here, understood. Okay. So final slide, and then we're going to move on to a live environment. So the signal line crossover, that's another, if not the most important, one of the most important aspects of the MACD. This is what we care about. So the signal line crossovers are the primary cues provided by the MACD. So the standard interpretation is to buy when the MACD, remember the blue line, crosses up through the signal line, the red line, okay? And sell when it crosses below the signal line, okay? So the upwards move is called what we call a bullish crossover, and the downwards move is called a bearish crossover, okay? So respectively, they indicate that the trend is an instrument is about to accelerate in the direction of the crossover, and that the histogram shows when a crossing occurs. Remember, when you get crossovers between the MACD and the signal line, the blue line and the red line, the histogram bar always records a value of 0, okay? Because you have the shift, okay? This is where the shift occurred. So hence, the histogram is the difference between the MACD line and the signal line. So therefore, it's no surprise that you get a value of 0. So when they cross, there is no difference between them. Okay, so the histogram can also help visualize when the two lines are approaching a crossover. Okay, so though it may not show a difference, changing size of the difference can indicate acceleration of the trend. And also the difference between the MACD, how far apart the two lines are growing, the faster and the more sharper the price action is actually making headway. Okay, so the larger the difference between the MACD and the signal line, the further they are apart, strong signals stronger momentum, either upwards or downwards, depending where the market is moving. Okay, so a narrowing histogram suggests that a crossover may be approaching, and a widening histogram suggests that ongoing trend is likely to get even stronger. Okay, so let's move on to the live environment. I don't see any suggested instruments. I don't know. Let's see, what do we have here? Yep, let's go for Netflix. Okay. MACD down here. Also have the RSI. I like to use them in conjunction. More specifically, I like to use them to spot much easier any possible divergences. So even though I look specifically for the RSI for any given divergences, I overlay that with a MACD to show to see whether the MACD is also recording moving a divergence, and if both of them are recording a divergence, in which in this prime example they do, okay, I am placing much more confidence in my scenario that the price action is going to move to lower ground in this kind of case, because you can clearly spot this here. After this, you see, oh, wrong tool. You see a higher high. Okay, this is the former high, irrelevant in this kind of case. RSI value creates a fresh. Let me do it like this. Give me 1 second, guys. Let's split them in order to see them much more nicely. Okay. Okay, two different indicators plotted together. Let's do it separately first and then overlay the overlays. Never thought I was going to say that, but still. So, price action records a high. Is this confirmed by MACD and RSI? Okay, MACD histogram. Yep, high. I see that. Is the RSI doing the same thing? Yep, I see that. Fair enough. Very nice. Now, price action continues to move north. Obviously, you get a higher low here, a higher high, a higher low, a higher high, a higher low, a higher high, a higher low once again. And somewhere in here, something weird happens. This kind of area. Let's shade it. Okay. So we see the peak of the price action. What has been going on with MACD and RSI below the chart? What are the oscillators talking about? Okay. So coincision in regards to the peak, no doubt. Bottoming out here, lovely. Coincision. From here onwards, look at that. Histogram should have been positive because we get a new higher high by the price action. No side whatsoever of a higher reading in the MACD. MACD should have been in the positive territory for this period I'm just highlighting here, okay? For at least 1 week. No, MACD is in the negatives, okay? Same thing happens here. Another higher high by price action. MACD barely got into positive territory, barely, okay? So this is the second indication that divergence may be taking place. RSI, we're not going to talk about RSI just yet. Again, same thing. Price action moves to higher ground, creates a new high, fresh high. MACD negative. Divergence. Clear as day divergence. Okay? Price action. It's upwards. MACD is not doing the same thing. Look at this. It's even low. Okay? Moving to lower ground. You see the lines? You see the arrows? Okay, one is pointing upwards. Price action is moving to higher ground, whereas, okay, whereas the MACD draws a completely different picture. It moves south. This is what we call divergence. This is where we pay close attention to this kind of level. And the primary bias that I would have had today would have been not today, but in this kind of period, in this kind of range, I would have been, if I was in this position, I would have been paying close attention and possibly having my finger on the exit button for as soon as possible, as soon as I continue to see, for example, this kind of thing, this kind of divergence being extended into the future. Okay, so and from there onwards, if I didn't have a position, my bias would have been for a short order. And that's okay. Possibly having a target down here where we had prior resistance, which has turned into now possible support level. Maybe this, okay. I'm going to give a little bit more room for the price action to head to high ground, okay. And we have a risk reward ratio of 5. We're talking about crazy. Okay. This is a lot. Let's just say adjust it down here. Much more applicable, much more safer. Okay. Cautionary kind of stance. But obviously we couldn't have had predicted this in pre-market. You see Netflix reported its earnings yesterday, even though the results are both a beat, both the EPS and the revenue figures have exceeded expectations for some reason, possibly due to the negative outlook going forward about the Netflix, I don't know, subscriber growth or new television series or whatever that is. I haven't had the time to investigate what has happened and why we see Netflix trending in the pre-markets by trending lower by what? Almost 6.5%. Unsure, but the technicals have indeed given me a heads up before this kind of happened. Obviously, these would have been much more different, okay, if we have had some sort of robust, even better than this kind of results, which could have skyrocketed in a sense the price action to high ground in pre-market today. Nobody knows. That's why we wouldn't have touched for example, yesterday, the day before this, even though you spot the divergence, it's a lot more risky to enter a position right before earnings if you have not done your homework. So personally speaking, I don't enter positions unless I do my homework first. And even though I do my homework, I'm kind of reluctant to place a trade before an earnings release because nobody knows what's going to happen. Okay. So either super beat, either dismal kind of results, they can create severe liquidity and volatility surrounding an equity, an instrument. So therefore, personally speaking, I like not to trade this. I like to see earnings releases and earning results before I place my trades. Okay. So in this kind of case, even though the technicals actually worked in our favor, it's not realistic to go beforehand. It's not advised anyways. No, who am I to give advice? But the point is, from a rational standpoint of view, it's way too risky to go before earnings and buy or sell something. Okay, unless you have some sort of privileged information, you've done your homework, and you expect uh, uh, the price action to move into one either direction depending on your info. Okay, in this kind of case, I have not delved into too much about Netflix. I don't know what happened, even though I can see the surface right now. Yeah, they have a bit of their EPS and revenue targets, and still the price action moves to lower ground in pre-market session. I have no idea what's going on. I'm gonna investigate this further and head on further from there onwards. Who knows? Maybe post today's market open, maybe you're going to see the price action moving back to the prior trading range. Okay. In a sense, people deep buying Netflix and taking, in a sense, for granted that they have beat both earnings and EPS targets. Who knows? We'll see. I'm going to wait and see at least 1 or 2 trading sessions after an EPS release, an earnings report, to get the gist of what's going on. What has happened? Did the volatility ease? I'm way too late now. Okay. I'm looking for what's going to happen into the future. But going back to the topic, MACD in this kind of case gave you an early signal that divergence, that for example, the bulls momentum, even though you have higher highs, the momentum of the bulls is waning out and the sellers are entering the picture. And most of the times you see these kind of sharp falls, albeit the earnings release in today's session. This may actually be technical, okay? This reaction, I mean, in the pre-market today, may be indeed technical, okay? So either traders spotting this kind of divergence, which has been going on for quite some time now. It's been on for, let me highlight this kind of period. Let's just say the earliest signal was from somewhere in here to here. So we're talking about a month. So a month of divergence, okay? So it's a lot of time for people to spot this. Maybe they did spot this, and that's why we see Netflix price action moving to lower ground, albeit favorable bits of their EPS and revenue targets. Okay, so again, let's look past this and let's do an actual study of using the MACD. Okay, so given the parameters, the components of the MACD, as we mentioned, we look for crossovers. This is a crossover. This is a bullish crossover because we have the MACD line crossing above, okay, the signal line, the red line, okay, creates this crossover, this bullish crossover. Let's highlight that on our chart. You see price action moving to high ground, okay. In a sense, this was a gap up post favorable releases of the earnings call, okay, the earnings report. This report, yesterday's report, was even much better than the prior one, and for some reason the price is falling, whereas here you see the complete opposite. It opens up with a gap up. This is going to open with a gap down into this session. We'll see how it behaves throughout the session, but yeah, look at this. So what do we see? The crossover right here. The actual signal to enter was when you see this, okay? And it's when the MACD line, the blue line, crosses above the threshold. So the MACD turns positive. That's when the actual entry point is, okay? So these may these could have very well been an entry, something like this. So playing it off here, risking in a sense 6%. I think that's relatively cautious. Okay. Whereas, do you await for the next crossover to occur before exiting your position, which is somewhere in here? Okay. This is the first initial sign for you to get the hell out. Okay. In this kind of case, we're talking about how much? 15% gain, and you are risking 5-6%. So yeah, 3 risk reward ratio of 1 to 3. That's very nice. This is my personal favorite. I like the 3. Okay. Not because I'm superstitious about the number 3, because I don't know, it's a healthy balance of what to expect. Okay. In regards to gains compared to the losses. Okay. Obviously, the more the better, but you have to wait longer. You have to be more patient. And you don't have to be that accurate in regards to your entry and exit points. Okay. The longer you are in a trade that goes to your direction, the better it is. But you have to be on top of it day in, day out to see whether it's moving to that direction or not. Okay. So the first signal to exit was up there. Could we have had a much nicer kind of exit? Yep. It would have been when you see the crossover between the MACD line, the blue line, below the 0 line, which has not yet happened. Okay. So this exit, you would have used the crossover. Okay. Much like the one we use as a signal. Okay. To enter the market after the crossover between the blue line. Okay. And the 0 line, the baseline. Okay. This is the signal. This is the actionable, let's just say, period. Therefore, with the same type of token, this crossover is the first signal to exit, but the actual closing of the position would have occurred after we see the MACD line, the blue line, crossing below the threshold, and this is the threshold. Let me highlight it for you, please. Give me a sec. This is the exit line. Okay. MACD is nowhere near that. I mean, it's moving now. Possibly this signal is gonna be given in today's session after we open. Okay. MACD line in this kind of case did not cross over or cross below the 0 line, the baseline, for over a period of what? We're talking about 25th of October of 2023. Okay. So we're talking about what? 5-6 months now of keeping a position open. That's why it's ideal. MACD is ideal for swing traders. Okay. So the maximum profit you could have had so far, if, for example, you close your position in today's session after you see this kind of, let me do it differently. Okay. So the maximum you could have earned, let's assume that the market is going to open with a gap, a negative gap. Apparently, that's what is going to happen. And given this sharp drop of the price action, at least if this materializes, most likely the MACD line, the blue line, is going to cross below the 0 line. So therefore, this is going to create the sell signal. So let's assume this is going to be the case. And let's see how much we are expecting to get from this. So close to 40% if we actually exit the position near at the start of the trading session without looking at what's going to happen afterwards. Okay. So comparing 15% to 40, there's levels to the game. So we're talking about a risk reward ratio of how much? Let's assume it's somewhere in here. So same thing. Okay, so we're looking at a risk reward ratio of 6.3 to 1. Beautiful. Compare that to 3, getting double than that. Yeah, 3 times as much actually in regards to percentage gain. Okay, so 40% comparing that to the 15. Okay, obviously there's magnitude to this, but if we have been paying attention to this and we have been spotting the divergence, okay, and we have successfully spotted divergence. For example, we exited market, let's just say somewhere in here, we're talking about a potential reward of 50%. Okay, 52%. Okay, so we're talking about 15, 40, and 52. Okay, so you see how significantly beneficial is the MACD as an indicator in a market or an instrument, looking at an instrument or a market that actually trends. Okay, so this is moving to a desirable direction, upwards, whatever that is, whether it's upwards or downwards, MACD can be used, okay, efficiently to time entry and exit points. Whereas when you have an instrument that is trading on between a close range, this does not work properly. MACD does not work properly, okay? So this is something you need to keep at the back of your mind, okay? Do we have more time? No. Unfortunately, guys, this brings us to the end of today's session, guys. I don't see anyone saying you want to look at something else. So let's just leave it at this. Thanks for watching. And we'll catch you next week for another episode of our series. For the time being, take care. Bye-bye. Have a lovely, lovely weekend. See you.